When people think about investing, they usually think about things like which ETF to buy, whether the S&P 500 is going up this year, or maybe even which hot new tech stock might make them rich. But here's the thing. One thing that matters nearly more is tax efficiency. Tax efficiency is simply putting the right investments into the right accounts so you don't get clobbered by taxes later in life. Now, why does this matter? Because taxes don't just nibble at your gains, they can devour them if you don't plan ahead. The accounts you choose at the beginning of your investing journey will shape how much money you keep decades down the road. And we're not talking about a couple of $100 here. We're talking tens of thousands, even hundreds of thousands of dollars that could be lost just to poor tax planning. Let's take a simple example. Imagine you invest $10,000 in an ETF today and it grows at 7% per year for 30 years. That turns into about $76,000. Now, if that money is in a tax-free account like a TFSA or a Roth IRA, guess what? You keep all $76,000. But if it's sitting in a regular taxable account, every single dividend along the way and all of your growth at the end gets taxed. That can easily chop off 25 to 30% or more of your total. Suddenly, instead of $76,000, you might only see $50,000. That's a $26,000 mistake. And remember, that's just one $10,000 investment. Imagine what happens with your entire portfolio over decades. There are different accounts, different rules, which I described in my last few videos, but a little overview. The TFSA in Canada or Roth IRA in the US. These are your tax-free growth accounts. Anything that grows inside them, you get to keep, no matter how big it gets. Perfect for stocks and ETFs that you expect to skyrocket over decades. The RRSP in Canada or 401k in the US, these accounts give you a tax break today. Your contributions are deducted from income, but later, when you take the money out, it's taxed as regular income. That means if you build it up too much, you could find yourself paying higher taxes in retirement than you expected. Still, these are great for things like US dividend paying stocks because they avoid withholding taxes, and also for bonds because interest income is taxed harshly in taxable accounts. Taxable accounts, these are your leftover buckets. You pay tax and dividends every year and capital gains when you sell. If you use them wisely, you can minimize taxes, but they're the least efficient place to stash investments long term. Say you put US dividend stocks into your taxable account in Canada. Right off the bat, the IRS withholds 15% of your dividends. Then Canada taxes what's left. That's a double hit. If those same stocks were in your RRSP, no withholding tax. Suddenly you're keeping 15% more of every dividend every year for decades. Or here's another one, bonds. Bonds pay interest, and interest gets taxed as regular income in Canada. So if you hold a Canadian bond ETF like VAB in a taxable account and you're in a high income bracket, you can be paying 40% plus on that income. Put the same ETF in your RSP and you avoid those annual tax hits initially and hopefully withdraw when you are on a lower tax bracket. Compounding works both ways. People love to talk about the magic of compounding when it comes to investment growth. But here's a dirty secret. Taxes compound too. If you lose even 1% of your portfolio to extra taxes every year, that doesn't sound like much, but over 30 years, it can cost you nearly 25% of your portfolio's value. That's a quarter of your wealth gone, simply because you didn't place your investments in the right accounts. Another wrinkle here is what's called home country bias. Many Canadians load up on Canadian stocks because they feel safe and familiar. The problem, Canadian stocks are only about 3% of the global market. If you stick too much in Canadian equities in your TFSA, you might miss out on global growth. On the flip side, if you put too much US stock exposure in your taxable account, you're leaving money on the table through taxes. The smarter play is usually use your TFSA for high growth global equity ETFs like VUN or XEC, where every dollar of growth is tax free. Use your RRSP for bonds like VAB, REITs like XRE, or US stocks where you save on US dollar stocks where you save on withholding tax. Use your taxable account for Canadian equities like VCN because Canadian dividends get preferential tax treatment at the personal level. Don't let future you get screwed. Here's the bottom line. Being tax efficient means you're not just investing for growth, you're investing for net growth. The number that matters isn't what the ETF returns, it's what you get to keep. Poor planning today could mean that your retirement lifestyle is thousands of dollars per year worse than it needs to be. Good planning today means you keep more of your gains, your dividends, and your freedom. So don't think of tax efficiency as some boring paperwork detail. Think of it as one of the highest return investments you'll ever make. Real world scenario number one, US stocks. Let's say you put 100,000 into a US stock ETF for 20 years. In a TFSA, no tax, everything grows tax free. However, the dividends are taxed at the US rate. At 7% growth, that's about $386,000 at the end. You keep all of it. In an RSP, you gain a little because you don't pay US withholding tax on the dividends and it grows tax deferred. However, the same $386,000, when you withdraw it, you will pay income tax. Still, You skip some taxes, but you pay more later. In a taxable account, the IRS takes 15% of every dividend upfront. Then Canada taxes what's left. Over 20 years, you might only see 320 to 330,000. That's $50 to $60,000 less just because you put it in the wrong account. Real world scenario number 2, bonds. Now let's look at bonds. Say you invest $100,000 in Canadian bonds like VAB. They pay interest, and interest is taxed at your full income rate. In a taxable account, if you're in a 40% tax bracket, you lose almost half of the bond income every year. That adds up to tens of thousands lost over decades. In an RRSP, those same bonds grow tax deferred. You don't lose a dime along the way to annual taxes. Over 20 years, you could easily have $40,000 to $50,000 more just by holding bonds in your RRSP instead of a taxable account. Real world scenario number 3, Canadian stocks. Here's the flip side. Canadian dividend paying stocks like VCN actually get special treatment in taxable accounts thanks to the dividend tax credit. So if you're going to hold something in a taxable account, Canadian equities are usually the best choice. If you instead put them in your RSP, you don't benefit from that tax credit, so you actually miss out. Putting it all together, the smart play is usually use your TFSA or Roth IRA for high growth global stocks and ETFs. VUN, XEF, XEC. Every dollar of growth is tax free. Use your RRSP or 401k for US stocks, bonds, and REITs, like VAB or XRE, where you save on withholding tax and avoid paying high taxes on interest. Use your taxable account for Canadian equities like VCN because dividends get a preferential tax rate. This could just be the overflow though. You still want to put some of this in your TFSA. The bottom line, being tax efficient means you're not just investing for growth, you're investing for net growth. The number that matters isn't what the ETF returns, it's what you actually get to keep. Poor planning today could cost you thousands every single year in retirement. Good planning today means you keep more of your money, more of your freedom, and more of your choices. So don't treat tax efficiency as some boring detail. Treat it as one of the most powerful levers you have to grow real wealth. And remember, I'm not a financial advisor. Everyone's situation is different. Your income, your goals, and even where you plan to live all matter. Do your research with the knowledge I've given you, or talk to a professional if you're unsure.